You're tuned in to the Restaurant Rockstars podcast. Powerful ideas to rock your restaurant. Here's your host, Roger Bodwin.
Welcome back. This is the Restaurant Rockstars podcast, and we're all about helping restaurants build their brands, rock their profits, and deliver amazing guest service experiences. We all know that it's tax time, and I don't need to remind anyone of that fact. So, this isn't always a pleasant time of year for most of us. We're busy running our businesses, and we don't really have the time to keep up with tax laws or the changes, perhaps, unless you're following the news. But even then, there's so much detail to this. It's really about, enlisting the help of an expert. So no worries. I've actually got an expert on the line today. My guest is Mr. Tony Perricelli. He's a CPA and a tax expert from a firm called Scott & Company. They're in Columbia, South Carolina. Welcome to the show again, Tony.
Thanks. Glad to be here, Roger.
Yeah, I'm really happy. Tony, it was almost a year ago, coming up this May, that we had you on the show the first time. And, we talked a lot about how to put your books in order throughout the year to give yourself the best tax position at the end of the year. And now it's kind of a last minute thing, but we know that lots of people are sort of scrambling to get their taxes in. So I'm really glad to have you on the show. You work with many restaurant clients today, so you understand our business. And you're in a great position to really help the audience with the last minute advice. So the tax deadline is next week, but I understand that you can extend until September. Is that correct?
Yes, that's correct. If you have an S corporation or a partnership that you're using to run your business through, then the due date is next week, March 15th. But you can extend for 6 more months through September 15th, so that's an option. Now, if you have a C corporation, which is kind of the old-fashioned corporation, or what a lot of the larger companies might use, those tax returns are not due until April 17th this year because of the weekend and holidays. It's not the 15th; it's the 17th. But for most folks who are running closely held businesses, it's going to be an S corp or partnership, and so March 15th is the deadline.
Let me ask you, when you mentioned partnerships, Tony, for the uninitiated, am I clear in saying that you're also considering limited liability companies or LLCs?
Yes, that's correct. So an LLC actually is a creature of whatever state you're doing business in. It's not the IRS doesn't even really recognize such a thing as an LLC. So an LLC is taxed as either a partnership or a corporation, or in some cases, if there's just one owner, it can be a sole proprietorship. So yes, when we talk about corporate and partnership tax returns, it's just the taxable entity type. It's not necessarily LLCs can be included in there. It's not necessarily the state entity type that you're talking about.
Perfect. Okay. So then that means that so S corps and partnerships, LLCs, all those have the March 15th deadline, which is approaching next week, and we can extend until
Right.
September the 15th. That's terrific.
Correct.
Let me ask you, if a company chooses to extend the return, are they more likely to trigger an audit by doing so? Are there any stats that have proven that?
I don't know that I've ever seen any research or anything that absolutely proves that or not. I don't know that there's any way to do that unless you actually work with the IRS, which I don't. So in general, I recommend that if you need more time, ask for it. There's nothing wrong with getting an extension. It's automatic. And in my experience, I've been doing this almost 20 years now. I've never seen any patterns that show me that you're more likely to get audited. One thing I will throw out there, though, is a big advantage with filing an extension is you have more time to potentially actually save a little bit of tax dollars from last year. Even though 2017 is over and done, there's actually an opportunity that some companies might have to fund a retirement plan for the owners and even some of the employees potentially. So there's a certain type of plan called a SEP, S-E-P, Simplified Employee Pension Plan, and it's basically like an IRA, And what that does is it functions just like an IRA, where you can contribute money to it, and there's a tax deduction up front, and then the growth in that account over the course of many years, as you continue to add funds, or as you invest in various stocks, bonds, mutual funds, those kind of things, the growth is not taxed. It's sheltered from tax until you withdraw it when it's time for you to retire. And you can do that at any time after age 59 and a half, just like a regular IRA or 401k. So the normal deadline for contributing to one of those types of plans is March 15th, or in the case of a C Corp, April 15th. But if you extend, like we just mentioned, the 6-month extension, that also gives you more time to contribute to a set plan through the extended deadline, which is September 15th. So in theory, you could actually, be August, September, and contributing money into the set plan, and you're getting a tax deduction for last year, which is really good. The timing on that is great, because you're spending money now and getting a tax deduction in the prior year. It's always better to have a deduction earlier than later. So that's very helpful.
That is a great benefit. I'm really glad you brought that up. What are some of the other ideas or last-minute tips we can talk about while we're still in 2017, whether you choose to file next week or you file that extension, before we move on to the new Trump administration's changes?
Well, one of the thoughts that, and actually we talked a little bit about this, I think last time I was on, is related to property and how property is depreciated. And one of the things that we can do after the fact is do what's called a cost segregation study. I think we may have talked about that last time. But basically that study is something that you do you get an expert who knows a little bit about engineering, a little bit about accounting and tax, kind of a cross-discipline type thing. And they do a study to break down the components of a building. So if you own your own real estate, or if you've got significant renovations that you've done to a lease space, then they can take that and break it down into components that can be depreciated very quickly. Because normally real estate is depreciated very slowly, especially commercial real estate. It takes a long time. So if you spend a couple $1 million, you won't basically be able to deduct that for 39 years. It takes a long time. The cost segregation study can shorten that time down to maybe 5 to 7 years for a certain percentage of those costs. Now that's something that can be done after the fact. Now the depreciation itself is not anything. It's not a deduction you're taking later for an earlier year. It's just you can still do that calculation anytime before you prepare your tax return. So getting an extension can give you an extra 6 months of time to get that study done, and so that you can have a better result for your depreciation. Also, and we can probably talk about this later when we get into the new tax law, there's actually one component of the new tax law that went into effect as of September 27th of 2017. It's one of the bonus depreciation rules, the updates on the bonus depreciation. So we can talk about that later. But that's something that we've actually already been doing with some of the returns we're preparing this year for 2017. We've gone ahead and looked back, and if those equipment or some of the real estate components were purchased after basically in the fourth quarter of 2017, they're eligible for some of the new rules, which are a lot of opportunities available for some of the new rules to quickly depreciate real estate costs.
I definitely want to get into that. While we're talking about extensions, I'm actually thinking of filing an extension myself. This is something that I've been working on I really start this whole process of getting my books in order. I mean, I work on them throughout the year, but just really starting to plan with my CPA in November. But, this is a crunch time, and no matter how big your firm is, you have so many clients, and you really want to offer every client individual attention. You want to give them the benefit of every possible, tax benefit that you can. So when things kind of calm down after the April or March deadlines have passed, do you find that, you spend more time on a return, or you can give it a little bit more detail than when you've got a pile of 30 on your desk? I mean, how would you answer that?
Yeah, that goes without saying. I mean, obviously, this time of year, things are very, very busy, and we're trying to move things along as quickly as possible while still maintaining high quality of service. So right. We certainly don't sacrifice that. But but yeah, that being said, if I'm sitting in my office and it's May or June or July, and there's not a lot of pressure on me, I can kind of take my time, really concentrate on what's going on, and it does allow for a greater sense of just focusing in on what's important to the client and what we can do to save money, and also I think too it gives us a better opportunity to do planning for the new year. Now, that being said, there's some value for having prior year numbers finalized and available early in the year. So the earlier you do your planning, the better. But if it's a choice between sitting down for 5 minutes and quickly going over something because we've got 30 other returns like you mentioned that have to be done, or having the time during the summer or the early fall to take more time, sit down for an hour or two, and really talk about what's going on. Yeah, certainly it does help out to have that additional time. So there's pros and cons both ways. In some cases we have requirements from banks or bonding companies and things like that maybe not so much in restaurants, but maybe in construction, other industries. Depends on the industry, but for restaurants specifically, sometimes the banks are requiring tax returns to be done early and submitted to them, so they have all the information for their underwriting to renew loans, things like that. So sometimes we don't have a choice; we have to get them done.
Sure.
But yeah, it definitely does. There are situations where it is nice to have that extra time available. So I would say don't shy away. I guess my advice is don't shy away from an extension for, like you mentioned before. I don't think there's really any should be any fear of additional audit scrutiny by the IRS or your state or anything like that. It is an automatic thing. It's not going to get rejected. The only thing you have to watch out for, though, is as you do your personal tax return, because generally if you have like an S corporation or partnership, you would also have to extend your personal return because you're going to have the information from that business return to put on your personal return. So you'll have to extend both. Just be careful and make sure that you go ahead and make the payments, any kind of estimated payments that you might have due for the prior year and for the current year, because you got to watch out for that. For 2018 and in the current year, the first quarter payment is due on April 15th. So you don't want to get well into the middle of the year and not having made any payments for the current year and kind of get yourself behind the eight ball there with getting behind on your payments. So even though you're not filing your returns, you still need to pay attention to estimating your profits and your taxable income and maintaining your payment schedule so that doesn't fall behind.
That's a good point, and I remember running into that with my own business as well. You talked about depreciation. I believe we were just talking about, long-term depreciation on property buildings, because obviously land is not a depreciable entity. But what about equipment and purchases that a business makes throughout the year, and they have to put together the depreciation schedule that lists every single item on it? And if you perhaps switch accountants, does that information follow you from last year to this year, or do you have to start from scratch and recreate that so that they don't lose any depreciation?
Sure, yeah, that's very common. We often will communicate with prior accountants and get the depreciation listing from them because you want to stay consistent from year to year. I mean, that's what the IRS requires. So if you're purchasing new equipment and obviously you want to take as big a write-off as you can, as quickly as you can. So it's good bookkeeping and accounting practice to go ahead and record those things and make sure you've got good records of what it is that you're purchasing and what the use is and when it's in service, and of course, obviously, how much it costs, and so then you can depreciate as quickly as possible. But yeah, certainly that's something that you want to carry over. Switching the account, it doesn't change anything. It doesn't reset the depreciation or anything like that. It just need to transfer that information from the old account to the new
not
account.
have it lost. Is it 5 years on new equipment, and they say that the usable life is just about depleted and that it's got a zero value, or can you explain?
Right. Yeah, for IRS purposes, pretty much all, I would say just about all restaurant equipment is going to be 5 years depreciation life. So that's it's a fairly short life, but I'm sure in most cases that's probably pretty accurate for a lot of types of equipment that are being used hard on a daily basis in a restaurant environment.
Let me ask you, Tony, in my business, when I ran restaurants for so many years, I purchased some new equipment. I purchased some, reconditioned equipment that still had a usable life. Does that change? Let's say I bought a Hobart mixer to make pizza dough, and those things last forever. They're pretty much bomb-proof. Well, let's just say I bought a 10-year-old mixer and maybe I paid $2,000 for it. Is there any depreciable life left to something that's already over 5 years old?
Yeah, it's the 5-year rule is when you purchase it. So if it's new to you, then that resets for you. So if someone could buy the mixer, and or any piece of equipment, let's just say you buy $1,000 piece of equipment, then you depreciate it, then you sell it to someone else. That person then gets, you sell it to them for $500. Then they depreciate the $500. Now, I probably should use higher amounts because there's the de minimis rule of $2,500. But let's say $10,000 and $5,000. Just substitute those numbers. So say it's $5,000 for you, then the depreciation resets. But that's actually that might be actually a good segue into some of the changes with bonus depreciation, because under old law for bonus depreciation, and I can define that in a second.
Okay.
Old law said bonus depreciation was not allowed for used equipment or used purchases of previously used items. Now, under new rules, that restriction is gone. You can actually take bonus depreciation on new or used items. So that's a big change from something we've had in the past. And I think where that came from is the original bonus depreciation dates way back to September 11th, 2001, after the terrorist attacks. They were trying to stimulate the economy, and that was I believe that was really the original origin of a lot of the bonus depreciation rules that we even have today, many years later. It was trying to stimulate the economy. So they wanted folks to go out and buy new items that were being manufactured and, supporting jobs, things like that. Well, I feel like now the change has occurred because, well, we're kind of so far removed from that, and, the economy is doing a lot better, and it's just more of a benefit to businesses. So the connection to the stimulation of the economy is not as tight, and so they've removed that restriction from the new bonus depreciation rules. But basically, bonus depreciation in a nutshell allows you to immediately expense either some or all of equipment purchases that normally would be depreciated over time, over several years, and so. In the past, that was there's been different percentages for different years. At one point, it was 100%, and then it went down to 50%. And over the last few years, the rules had changed to where it was phasing out. And bonus depreciation was actually scheduled to be phased out by the year 2020. So really, we only had just a few more years, and the percentage of rate that you could take was only 50%. Okay, so that was the existing rule going into last year, 2017, or as of the end of 2017. So now with the new law, the changes are, first of all, you can take 100% of these items, anything that's eligible, and we'll talk about that in a second. Anything that's eligible, you take 100%, and the 100% rate is good through 2022. So we've got a couple extra years, and then from the years 2023 to 2028, there'll be a phase down, and it'll go, I think, from 80 to 60. I think it's 20% a year for a couple of years there, but it will phase down over time. So as of right now, bonus depreciation is back for a few years at 100%, and then it'll phase down over 5 years to where it'll go away again, and we'll just have to wait and see if it'll be renewed. But another change is, like I mentioned before, you can now take either new or used property. So you don't have to be purchasing anything new to take this bonus depreciation. And in addition to personal property, which, like you mentioned, equipment and things like that, you can also take pretty much, there's several types of real estate that you can actually take bonus depreciation on, including most interior improvements. So that really, I think, will be very helpful for any type of a restaurant that either owns its own space or is leasing. For instance, we've got, several clients that just lease space, and, We've got some that own it too, but the ones that lease, I mean, you can put, as you know, $1 million or more into an upfit of a space to get it ready to run a restaurant in it. So
absolutely,
that's quite a bit of cash to be spending, or in some cases, you're borrowing the money to finance it. But at the very least, you're probably putting at least some of your own cash into this. And so being able to take bonus depreciation on that is, I think, a big, really a boon to a lot of folks to be able to quickly take those expenses against their income. It's going to be a real big help. So, being able to take that, and then when you're talking about other types of allowable expenses, basically you've got. I'm going to read this out to you here.
Okay.
I've got a list in
Please.
front of me for property that is an existing. This is okay. So basically, anything that's brand new. So if you're building a new building, or you're going into a brand new space, these types of things are not eligible. But anything that's like an existing building that you're going in and doing upfit in, that has the potential to take bonus depreciation on it. All right, and so that's where we're going to see most of the benefits. But the one thing I wanted to mention is, excuse me.
Mm-hmm. Yeah.
Okay, so for real estate, so for restaurant property, the old law said any type of property that's specifically being used as a restaurant property was depreciable over 15 years. So that's actually a different rule. That rule is actually gone, and so that has been eliminated. And now what you have is just any type of general improvements being done to a space. So I don't know if that really is a help for restaurant companies, but it allows you to be able to say, for instance, maybe you're using your space partly for a restaurant and partly for something else, maybe offices or maybe retail or some other type of use. It kind of expands out what can be taken under the bonus depreciation rules.
Is there a minimum amount? I think that there's a maximum of $510,000 in cost or value on some of these renovations or equipment, but is there a minimum?
Well, no, that's a different rule, and actually we can talk about that too. That's Section 179.
Oh,
so these are two different things.
Okay, I'm sorry to confuse.
That's where that's okay, because I think in a lot of cases there is some confusion between the two. So bonus depreciation, I think and so maybe we can go into the differences in that.
Please do.
Bonus
Tony,
depreciation is allowed for pretty much any company out there. Even your largest companies can take that. So it doesn't matter how big you are, you've got the ability to take bonus depreciation. Now, Section 179 is a different animal because what it is, it's not allowed unless you have less than $2 million worth of property placed into service for the whole year. Okay, so that's going to limit this. Section 179 is generally limited to your smaller companies. All right, now $2 million may sound like a lot of property, but again, if you're doing renovations or if you're equipping a kitchen, equipping a dining room, I mean that can get used up pretty quickly. So Section 179 is very similar to bonus depreciation, but it does have those limits on it. And so the changes for Section 179 are like this. Under prior law, if you put more than $2,030,000 of equipment into service into 1 year, then you were no longer eligible for Section 179. But if you are eligible for Section 179, the maximum you could take is $510,000. Now, to answer your original question, no, there's no minimum on this. It doesn't matter what the smallest amount is, but there's only maximums.
Gotcha.
So that's the old rule. The new rule is that you can put into service up to $2.5 million, and you can expense immediately up to $1 million.
Okay.
Okay. So these are two different things, and I think and I know some of this is kind of confusing, probably talking, without maybe seeing it on a chart or, visually. But I think that's one of the reasons it is important to have someone like me or an accountant that can sort all this out, because you have to make a choice and you kind of have to look to see which one of these works better for you. And in some cases, you might look at it and say, well, we clearly don't qualify for Section 179. So in that case, I'm just going to take the bonus, and because that's all I qualify for. But if you do qualify for the Section 179, that might be the better option. And one reason potentially that might be a better option is because in most states, they don't require you to adjust out the Section 179. They allow the Section 179, but they do not allow the bonus. So, for instance, in my state of South Carolina, if I were to take two identical assets, let's say they're $50,000 each. The first asset, I take bonus depreciation on it, $50,000 deduction. When I do my state of South Carolina tax return, I have to remove that $50,000 deduction and do just normal depreciation on it. So it might be, say, $10,000 or $15,000 I could get in the first year. It's a 5-year property. But take that same asset, $50,000, I take Section 179 and choose to elect to take the Section 179 deduction. It's $50,000 deduction, and that same deduction applies for the state of South Carolina. So I don't have to adjust it. So that's one big advantage to Section 179 over bonus if you qualify for it. Also, something I was alluding to earlier with the improvement property, with Sections 179, they have the new tax law allows you to take certain components of a building, like actual structural components. So roofs, HVAC, fire protection equipment, alarm and security systems, and things like that normally would be included in the structural components of the building and would not be eligible. So that's actually a brand new thing that we're seeing under the new law that is allowed with Section 179.
That's great.
So I feel like that it's a lot of information, and you can kind of it's kind of dizzying to think which one should I do and how should I handle it. But the best advice I can give is to sit down with someone who has experience with this and can run your tax return both ways. We can take what does it look like with bonus? What does it look like with Section 179? Is there some combination of the two that we can take? Do you even qualify for Section 179? How is it going to affect your state tax returns that you're going to have to do? And look at all those factors and decide which one is best for you. So, with all the changes, there's a lot of opportunity available, but there's also some pitfalls, and you could get in a situation where maybe you kind of kick yourself later and say, "Oh, I could have done it better this way." So, planning is very important with depreciation nowadays.
I'm really glad you brought that up, because that's a great point about, sitting down with your professional and just going over these things item by item. But I also want to let the audience know that Tony wrote a recent article, and it's called 5 Things That Every Hospitality Business Owner Should Consider in the Tax Reform Law. And it's really easy to understand, and it's very comprehensive. I'm going to include a link to this article for the listeners out there, Tony, within the show notes. So, it's easy to listen as you're driving along, but there are a lot of key details that you're going over that, probably want to be, revisited. And I think the article is a good place to start before they sit down with a professional so they can ask the right questions.
Right, and that article just gives a nice brief outline of what I just talked about, because again, as a restaurant owner, you don't want to get bogged down in the details of what qualifies and what doesn't. But I think it's worth a conversation. Let's say you're opening a new location. Go talk to your CPA and say, if we do it this way, what are the implications? Do you recommend doing it differently, or is there something different I can do that can lead me to a better result from a tax standpoint? And have that conversation before you ever do the renovations or do the upfit or purchase the equipment, because once it's done, you might be limited in how you can depreciate things and what your result might be for tax purposes.
There's some other big changes from the Trump administration for 2018. We can talk about pass-through entity income. Do you want to cover that now?
Yeah, sure. That's a big change because that's one of the few changes that exist in this new tax law that is brand new and didn't exist in the past. So it's not just a modification or an update of something; it's something that's brand new. So as we talked about earlier at the beginning of the show, S corporations, partnerships, and I'll include in this discussion sole proprietorships. These are basically what we would call pass-through type entities. What that means is the company itself, the entity, the LLC, the corporation, the partnership, whatever it is, does not pay tax. The taxable income is calculated by the company, and then that income passes through or flows to the owner. And the owner then pays the income tax on his or her tax return individually. Okay, so for those types of entities, S corporations, partnerships, and sole proprietorships, there's a brand new deduction called the pass-through entity deduction, and it's a 20% deduction. And it's very simple. You take your taxable income from that company, 20%, and you take it as a deduction. There's really not much to it. Now, that being said, with like any good tax provision, there are restrictions on who can take it. All right, so here's the first restriction is the type of business that you're running, and what we call the specified service businesses are not allowed to take this deduction. Now, I don't think this is going to impact too many restaurants or hotels or manufacturing companies or retail stores, folks who are dealing with physical products or making things or selling things, tangible things. For the most part, it's not going to affect those types of companies. Who it is going to affect is folks like me, accountants, lawyers, doctors, consultants, investment advisors. We're the type of folks that are probably going to be excluded from this deduction, unfortunately. But that being said, I bring it up because I've run into some situations in the past where you've got someone who maybe, maybe take you, for example. You've owned a restaurant in the past, but now what you do is consulting. So maybe you're doing that at the same time. Maybe you've got an operating business that's a restaurant or a hotel, whatever it is, and then you're also doing consulting for other companies as a side business or just as a part of your mainstream business, your main business. You've got to look at that and break those down to see which one qualifies for this new deduction and to confirm, if you do or do not qualify. Now, if that's the case, just being a consultant on the side doesn't disqualify you from the deduction. So you can break it up and, the deduction can be applied to the portion of your business that does qualify. So that's one thing. The second restriction is you have to have W-2 wages in your business or tangible property that's used by your business. Mm-hmm. Okay, so what that means is, like we were just talking about, equipment, real estate, various things that you're using, tangible property that is being purchased to use in your business. I would say for the most part, most restaurants have that because how are you going to cook your food or serve your food or where your patron's going to sit, if you don't have some type of equipment that's being used in your restaurant. So that generally won't be a problem. Also, W-2 wages. Very few restaurants or companies that can survive without employees. So, except for the very, very, very small ones possibly. But in general, I bring those two items up because again, it is part of the rules. But I don't think it's going to disqualify too many restaurant companies out there because most of them will have those attributes to them. Now, all that being said, those two restrictions, the type of business and whether or not you have employees and equipment in your business, those only apply if your overall taxable income is over $315,000 if you're married or $157,500 if you're single. So that's another thing you have to look at. If you're under those income thresholds, you don't even have to worry about the restrictions we just talked about, the service businesses or the wages and property. But if you are over those amounts, then you do have to look at those two restrictions and run your income, your business through those filters to see if you do qualify. But assuming you do qualify, it's really it should be a nice deduction for folks. The only problem I can see right now is I feel like there's going to be some either litigation or confusion or probably some arguments about what does and doesn't qualify and how things are written. There's probably going to need to be some clarification in regulations, things like that, because we've never had this before. This is brand new. And, the interpretations of this law run the gamut, from someone might say, well, just about everybody's going to qualify, versus somebody might, on the other end of the spectrum, might say, well, there's very few companies that are going to qualify. So I've seen commentators that have said, either extreme. So I think what we're going to have to do is be careful about this and take it one step at a time. And again, talking to your CPA, your professional up front, like we talked about, maybe over the summer when things aren't as crazy. Take some time, set up an appointment with your CPA, sit down and say, do you think I'm going to qualify for this deduction? Let's go through the rules one by one and see if I'm going to qualify. And then you can have some confidence going into next year when you're doing your 2018 tax returns, when this begins to apply, that you can either take it or not take it.
Well, that's a great benefit, and I do think a good majority of our listeners are going to qualify for that one. So I'm really glad we got a chance to talk about it. Let's talk about, there's some new limits on deducting losses in your hospitality business as well, Tony. Do you want to take us there?
Yeah, we can talk a little bit about that. Basically, what's going on there is, I guess maybe just talk initially about what it means to deduct losses. And again, this is something I think that we're going to have to see how it all fleshes out going forward. But essentially, in the past, if you have a loss, a current year loss in your business, then you are essentially able to, of course, apply that loss against other income you might have. So let's say you're married and maybe your spouse has a 9-to-5 job and just gets a W-2, makes an income, and maybe you're running your business and either you're in a startup mode or you're in a transition or you have a bad year or something happens and you end up having a loss on your business. Well, you can take that loss and apply it against your personal income and essentially reduce maybe either your spouse's income or other investment income, things like that, and reduce your taxable income. So that's been the rule all along. That rule hasn't really changed. It's just now that there's limits on how much you can actually take, and you're not actually allowed to completely wipe out your other income based on taking losses from a business. And also, in the past, something you could do is you could actually take that loss and you could carry it back a couple of years. So generally, the general rule, there are some exceptions, but the general rule is 2 years. And so what you could do is you could take a loss in 2017, you could carry it back to 2015, and you could kind of rerun your tax return in 2015 with that loss and say, hey, I would have ended up with a lot less tax if I'd had that loss in 2015, and the IRS will accept that and basically allow you to get a refund potentially of the tax that you paid that year. Unfortunately, though, that is no longer the case. So we're no longer going to be able to take losses back 2 years. You're only going to be able to take losses forward. So that's unfortunately one of the big changes that's occurred. And I think what we're going to see is it's going to limit. Again, you think about the life cycle of a restaurant company or any type of company, really any type of company that's just getting started. And typically, you are going to have probably some type of losses, maybe in your first year or 2 years, something like that. So I think that's a little bit unfortunate that those options are no longer available, but we'll see. It may just cause folks to do a little bit better planning and moving forward so they are prepared to be able to take those losses forward rather than taking them backwards. But I think, it is going to be, that is one benefit that I think is no longer going to be available, which is unfortunate.
Yeah, I wanted to bring that up because, a lot of companies that might be new into this business, like you mentioned, 1 or 2 years are going to show losses until they turn the corner. So, They want to make sure that they're putting themselves in the best position moving forward. So I thought that was important to discuss also.
Right.
What? Go ahead.
And just one thing to add on that, there's actually one restriction on those net operating losses that I just mentioned is that you can only, as you move forward, and if you have a current year loss, you can only offset up to 80% of the taxable income for the year. So again, going back to the example, let's say your spouse has W-2 income and you're running your business with a loss. If your spouse has $100,000 of income, you have $100,000 of loss. you can't completely offset those. You can only take 80% of your loss, so $80,000 against the wages of your spouse, and you'll still have $20,000 of taxable income for the year. But that additional $20,000 that you couldn't take this year, you could carry that over to the next year. So you don't completely lose it. It's just a matter of timing and when you get to take it. So that is one more restriction that is in place as well.
Very good. All right. Is there anything else that we've missed, either for 2018 or any last-minute tips for 2017 that we still need to cover?
One thing I've been mentioning as I've talked to restaurant and hospitality company owners recently is a new restriction on business entertainment deductions. And I bring this up for two reasons. First of all, it's something that if you're doing any entertaining in your business, which we do occasionally in our business, but it depends on the industry. But you're no longer able to deduct that. So that's a kind of a step in the wrong direction, I think. So that's one thing. And entertainment deductions, what we mean by that is not meals, but things like tickets to sporting events or golfing or things like that that are not focused around food or meals. It's other types of entertainment. So in the past, that was all, you could take a 50% deduction on that. Now there's no deduction allowed for that. So I think that's potentially going to hurt, the taxable position of a lot of companies from that side. But also, I feel like when you talk about restaurants and hospitality and leisure type companies in general, there could be a big shift in the corporate budgets that are available to purchase those types of services and those types of entertainment, things, entertainment options. So that's something that could negatively affect the revenue of the types of companies that you and I work with. So I think it's something at least to be aware of. That, let's say, for instance, you're running a country club or some type of a venue that has sporting events or theater or other types of things, as well as a restaurant maybe attached to it. You could see some of your revenue from the entertainment portion could be lower than usual in the coming year because maybe companies realize, well, we can't deduct this like we could in the past. Not to say that companies won't do that anymore because there's some value. Obviously, they're getting value from it now, or they wouldn't do it currently, but maybe the value isn't as much if they're not able to deduct some portion of it. So I've been kind of throwing that out there to a lot of folks just to be aware of and something to plan for. And maybe what we'll see is some type of a shift in the way pricing occurs or the way packages are presented to corporate clients or corporate customers, where more of the dollars are going into the meal portion rather than the entertainment portion. So we'll kind of have to see how that works itself out.
It's been a wealth of information as always. Tony, you're easy to talk to and you explain these things really, really well, even though some of these subjects can be complex. I'm really looking forward to sharing your contact information in the show notes also. If anyone out there is seeking a new accounting relationship, or even at the last minute, if you need a change here, I'd certainly like you to look up Tony at Scott & Company in Columbia, South Carolina. It is a virtual world. We do now communicate via email and phone and Skype, and you can upload any of your documents easily. It doesn't necessarily have to be a face-to-face relationship. So I really appreciate having you on the show. Anything last minute you want to share, Tony?
Well, I think, we've got a lot of opportunities here, and that's the way I've been presenting this, is trying to look for the positive in all the changes. You see a lot of negative press about the tax changes and how things are going to affect businesses and individuals. And, we didn't really even talk about the individual changes. There's a lot of changes there. But I think overall, when you talk about a business like a restaurant that has a lot of money invested in people and in equipment and things that are tangible, there's going to be a lot of opportunity to take deductions that either weren't there before or accelerate deductions that were slower in the past. And so you just got to look for them and kind of have your eyes open and be aware of what's going on. There's and actually one thing I didn't even mention before was there was the recent budget law that just passed to avoid the government to stop the government shutdown. They actually renewed for one more year something called empowerment zone credits, which is a rarely used credit. We actually have an empowerment zone here in Columbia, South Carolina. But the point of that is that maybe not a lot of your listeners will be able to take that credit, but you got to be paying attention to what's going on, because something as innocuous as a budget deal just to avoid a government shutdown, there's tax provisions, tucked away in there. You've got to pay attention and kind of be aware of what's going on. And so it pays to seek the counsel of a qualified professional and someone who is watching and looking at the news and reading and absorbing that material and helping to understand it so that it can be used to the best advantage to you as a business owner.
To me, it can be so overwhelming. I mean, I give you a lot of credit because you're a true professional in what you do, Tony. But when all this new legislation gets passed, I mean, isn't it a tremendous amount even for a professional to keep up with? You're constantly being sent new articles. And how is this information disseminated to you personally or to your firm generally when changes are made?
Well, I do rely a lot on articles that I read and resources that we have, and we subscribe to research services, and those folks real quickly getting things written, and I think in a lot of cases they have advanced knowledge of what's going on and are basically prepared to write commentary on that. So we rely on them. Also, we're part of an alliance of accounting firms, and we have a tremendous amount of resources through the BDO alliance that we're part of, and they're really good about putting out information as well. But yeah, I think in a lot of cases it's just a matter of sitting down and digging into the articles, digging into the commentaries, of course looking at the law itself, of what's been passed, and just talking about it. I mean, one thing that's been really helpful for me giving presentations and writing articles is that I've learned the material pretty well. I'm not going to say I'm a complete expert on everything, every aspect of it, but the things that really pertain to my clients and the folks that I work with, I've paid a lot of attention to them and studied them, and I think I've got a pretty good handle on it. And and if there's questions, I've got all these resources I can go to. So yeah, it is a little bit overwhelming at times, but I feel like that you can't ever rely on your own memory. You need to have resources available and that you can fall back on to confirm. And you can say, well, I don't know everything about this, so let me make sure and do the homework and make sure it's correct the way we're doing it. And to have a comprehensive system that kind of takes into account all the different factors. So that's kind of the way we handle it.
Well, I know we can't do it ourselves. We're too busy running restaurants, so it certainly helps to have a pro in our corner, especially at this critical time of year. Well, thank you so much, Tony, for being a guest. Again, I'm going to include a link to your article because I think it really clearly and efficiently explains a lot of the things we talked about today. It's a really good first step before someone sits down with their CPA. And I definitely wouldn't discourage anyone from considering the option of taking an extension on the return, especially if you're scrambling at the last minute and you want to make sure that you give yourself every advantage. So that was the Restaurant Rockstars podcast, and we'll see you next time. Thanks for being my guest, Tony. It's always a pleasure.
You're welcome. Glad to be here.
Thanks for listening to the Restaurant Rockstars podcast. For lots of great resources, head over to restaurantrockstars.com. And while you're there, download a copy of the book, Rock Your Restaurant. It's a game changer. See you next time.